Look, we knew that the bottom line was going to be improved. If we go back to the budget a year ago, it improved by 105 billion. In the mid-year update, it improved by 110 billion. And today it improved by another 114 billion. So that's given them extra money to put into the economy, but also to address the huge debt issue that we're now facing.
So you think that that mix between sort of short-term support and that long-term kind of budget healing, you think that's about the right sort of balance at the moment?
Yeah, well, there's three parts to it. The first part is the short-term support, and we saw that in the cost of living payment, the $250, and we saw that in the reduction in the petrol levy. And then we also saw the surprise, which was half of the Lamido being brought forward by a year, so giving people another $425 from July this year. So there were three significant short-term impacts. And then we looked for some longer-term impacts around supply, so some encouragement for businesses to employ more apprentices, encouragement for businesses to invest in training. And so generally, the balance looked to be about right, with, as I said, about 2/3 of it going towards fiscal repair.
Do you think that there is potentially a risk here that we might actually see too much demand coming from these policies and then potentially higher rates as a result?
Look, it's the total spending over the 4 years is 1.7% of GDP. If we compare that with the 2019 budget, it was 0.5%. But when we look at the previous two budgets, the COVID budget, it was 4 and 5% of GDP. So it's a bit more than I expected, but I don't think it's enough to say, shock horror, the Reserve Bank's going to go to work on, the governor will go to work tomorrow and so we must raise interest rates. I think there's enough there to suggest that there's some cover, but not something that's going to massively increase demand.
Can you tell us a little bit about sort of what's been provided in the budget for businesses? Obviously they've had a lot to deal with recently with regards to COVID, supply chain issues and obviously inflation impacting sort of input prices as well. How is the government looking to try and support them at this time?
Well, there was some help with regard to tax payments. The timing has improved for them. The second one was subsidies for training, so they're getting a tax benefit of $120 for every $100 spent on training. Third one is that they're getting another subsidy for keeping on apprentices, a $5,000 subsidy for that. And there just wasn't enough appetite to actually cut the corporate tax rate, which of course may have been something that some people may be advocating.
How do you see politics affecting this budget?
Well, there's a couple of points here, Elliot. The first one is that the news poll has them at 45%, whereas going into the last budget they were at 47%. They got a 1% kick, so coming out of the budget they went from 47 to 48, which got them within striking distance of the opposition. This time they're 45%, so they're going to need an even bigger kick along. So they've gone a bit harder, they've gone 1.7% of GDP, but at least we didn't see the sort of policies that some people feared that may have done quite a deal of damage to the economy. 1.7% of GDP over 4 years I think is acceptable.
Obviously seen US federal funds expectations rise quite dramatically this year. Is there kind of, I guess, a risk of the RBA looking to those international sort of benchmarks rather than sort of focusing on domestic conditions and when they think about raising rates later this year?
What we have to remember with the RBA, they're still patient, they still believe they've got time on their hands, and they're not seeing the sort of explosive inflation and wages story that we're seeing in the US. And our forecast is that in 2023, inflation pressures will start to ease, and in 2024, wages pressures will start to ease. So I think the RBA's very much in the wait and see category, rather than today, as we saw, the market's expecting the peak interest rate to be 3.6% against our 1.75%. This is by far the largest gap I've ever seen between our views and the market views, and we're feeling quietly confident that we'll be right. And I haven't seen anything in the budget overnight that would change that.